Three private companies you never elected, never hired, and can never fire are quietly deciding whether you can buy a house, rent an apartment, or get a job. They don't work for you. They don't work for the government. They work for the banks. And the score they assign you, the one that follows you everywhere, was invented in 1956 by an engineer who had never lent a single dollar in his life. His name was Bill Fair. His partner was Earl Isaac. And together they built a mathematical model that was supposed to remove bias from lending decisions. The idea was simple and, honestly, not terrible. Instead of a bank manager deciding whether to give you a loan based on whether he liked your face, an algorithm would do it. Objective, consistent, fair, presumably, given the guy's name, what they built became known as the FICO score. And for about 30 years, it stayed relatively quiet, used internally by lenders, invisible to the people it was scoring. Most Americans had no idea a number was being assigned to them at all. Then, in 1989, something changed. FICO went public with the score. Lenders started advertising it, and almost overnight, this private three-digit number became the single most important metric in your financial life. More important than your income, more important than your savings, more important than how long you'd held a job. The score was everything, and most people just accepted that because it came dressed up in the language of objectivity. Here's the thing about objectivity. It only works if you're measuring the right thing. So what does the FICO score actually measure? Because this is where the gap between what you've been told and what's actually happening starts to open up. The official answer is that your credit score measures your credit worthiness, how likely you are to repay a debt. And technically that's true, but credit worthiness to whom? For what purpose? Because the score wasn't designed to measure whether you're good with money. It was designed to measure whether you're profitable to lenders. Those are not the same thing. Here's how it actually breaks down. Your FICO score is calculated across 5 categories. Payment history is the biggest one, 35% of your score. That's whether you pay your bills on time? Fine. That makes sense. Then there's amounts owed, 30%. That's your credit utilization, meaning how much of your available credit you're actually using. Then length of credit history at 15%, then credit mix at 10%, meaning what types of debt you carry, and finally, new credit at 10%, which tracks how often you apply for new credit lines. Look at that list carefully, because 4 out of 5 categories don't measure whether you're good with money. They measure how deeply embedded you are in the debt system, how long you've been borrowing, how many different kinds of debt you carry, how consistently you keep balances without paying them off entirely. The system isn't rewarding financial responsibility, it's rewarding financial participation. And here's where it gets genuinely strange, because the credit score has a well-documented problem that nobody in the industry likes to talk about. It actively punishes certain kinds of financially responsible behavior. Pay off a loan early, your score can drop because you've eliminated an active account from your credit mix. Close a credit card you never use, your score drops because your total available credit shrinks and your utilization ratio goes up. Never borrow money at all, your credit invisible. No score or a score so thin it might as well not exist. And to a lender, no score reads the same as a bad score. There are currently around 26 million Americans who are credit invisible. Not because they're financially irresponsible, because they've never participated in the debt system. Immigrants who arrived with savings and no U.S. credit history. People who grew up in cash-based households. Elderly Americans who paid off their mortgages decades ago and haven't borrowed since. The algorithm looks at all of them and sees a question mark. Meanwhile, someone carrying 4 credit cards, a car loan, and a personal line of credit, all with balances, can have an excellent score because the system sees that and thinks this person knows how to manage debt. What it doesn't ask is whether they needed the debt in the first place. Now, you might be thinking, okay, this is imperfect, but it's still the best system we have. And that's a fair argument. Except for one thing, the 3 companies running this system, Equifax, Experian, and TransUnion, aren't just passive scorekeepers. They're businesses. And their customers aren't you. Their customers are the lenders, landlords, and employers paying to access your data. You are the product. The score is the packaging. And as businesses, they have an interesting incentive structure because the more integral credit scores become to daily life, housing, employment, insurance, utilities, the more valuable their data becomes, which creates a quiet but powerful motivation to keep expanding where scores are used rather than questioning whether scores should be used there at all. Think about that for a second. 3 private companies are profiting from the expansion of a system that scores you. And the more places your score gets used, the more money they make. Nobody elected them to this role. No legislation created them as gatekeepers. They just became that. And somewhere along the way, everyone agreed to play the game. The credit bureaus are like a group project where 3 people decided they were in charge, started grading everyone else, and somehow the teacher just went along with it. This isn't a new problem either, because the credit reporting system has a history that doesn't exactly inspire confidence. Before FICO standardized scoring, credit reporting was handled locally, by small agencies that kept paper files on individuals in their communities, and the information in those files was not strictly financial. Reports from the 1960s and earlier contain notes on a person's drinking habits, marital problems, political affiliations, and personal reputation around town. Whether your neighbors liked you, whether your marriage seemed stable. The Fair Credit Reporting Act of 1970 was supposed to clean all of this up. It restricted what could be reported, gave consumers the right to see their files, and created a process for disputing errors. It was a meaningful reform, but it didn't change the fundamental structure. So 3 private companies still controlled the data, still sold access to it, and still made errors at a scale that should make everyone uncomfortable. Today, the Federal Trade Commission estimates that roughly 1 in 5 Americans has a material error on at least one of their credit reports. 1 in 5, an error serious enough to affect their score. And the process for disputing those errors, the one the Fair Credit Reporting Act created, is notoriously slow, opaque, and frequently ineffective. The Bureau investigates the dispute by asking the lender whether the information is correct. The lender who reported the error in the first place confirms it is. Dispute closed. You can be wrong on paper for years, and the system designed to fix that has a financial incentive not to work too hard. So here's the part nobody actually tells you, because most financial content either tells you the credit score is broken and leaves you there, or tells you to game it without explaining why the game exists. Neither is useful on its own. The score isn't going anywhere. Like a lot of systems built for institutions rather than individuals, it's become so embedded in the infrastructure of financial life that you can't opt out. You can't negotiate the methodology. So the only move is to understand exactly what it's measuring and work with that. Not because the system deserves your compliance, but because the cost of ignoring it is real. Here's what actually moves the needle, and none of it requires carrying debt you don't need. Utilization is the fastest lever you have. The score rewards keeping your credit utilization below 30% of your total available credit, ideally below 10% if you're optimizing aggressively. Which means if you have a $10,000 credit limit across your cards, you want your reported balance below $1,000 when the statement closes, not when you pay it. When it closes, because that's the number that gets reported to the bureaus. Pay it off in full the day after if you want, but the snapshot they capture is the statement balance. Your oldest accounts are your most valuable accounts, not because of sentimental value, but because length of credit history makes up 15% of your score, and the age of your oldest account anchors the entire calculation. Closing an old card, even one you haven't touched in years, collapses that anchor. The better move is to put a single small recurring charge on it, pay it automatically, and forget it exists. It keeps the account active, keeps the history intact, and costs you nothing. Hard inquiries matter less than people think, but they still matter. Every time you formally apply for new credit, a hard inquiry gets added to your report and your score dips slightly. The dip is small, usually 5 to 10 points, and it recovers within a year. The exception is mortgage and auto loan shopping, where multiple inquiries within a short window get treated as a single inquiry. The bureaus understand rate shopping. What they penalize is applying for 4 new credit cards in a month, because that behavior looks like financial distress, not financial ambition. And if you find an error, which statistically 1 in 5 of you will, the fastest path to resolution isn't the Bureau's online dispute portal. It's a written dispute sent by certified mail, which legally requires the Bureau to investigate within 30 days and triggers more accountability than a form submission that can be auto-processed and dismissed. It takes longer to send. It works better. None of this is complicated once you understand what the system is actually measuring. It's measuring your performance as a borrower. So perform deliberately, not blindly. If you want to actually understand the systems that are quietly shaping your financial life, not the version they put in a press release, but how they actually work and who they actually serve, hit subscribe. Because the credit score is one of a dozen systems just like this one. Systems that look neutral from the outside, that come dressed in the language of fairness and objectivity, but were built by someone for someone, and that someone wasn't you. And now that you know how the scoring actually works, drop your take in the comments. Do you think the credit score system is fixable, or is it too embedded to ever actually change? Let's see how split everyone really is. The score isn't a scam, but it's not what they told you it was either. And knowing the difference is worth more than a few extra points.